I sold my I stocks. Not a little, not a partial reduction, not a cautious rebalance. I sold them completely. And the moment I say that, many people immediately think the same thing. Why would anyone do that now? AI is everywhere. Every headline talks about it. Every investor seems convinced it is the future. The biggest companies in the world are spending hundreds of billions of dollars building AI infrastructure. The stocks keep making new highs. Selling feels almost irrational, but that feeling is exactly why I want to have this conversation. Because throughout financial history, the moments that felt the safest often turned out to be the most dangerous. The moments when everyone agreed on the same outcome were often the moments when risk was hiding in plain sight. I am not saying AI is a bad technology. I believe artificial intelligence will reshape industries, businesses, and perhaps society itself. What I am questioning is something completely different. I am questioning whether the prices investors are paying today already assume that entire future has arrived. There is a huge difference between believing in a technology and believing in the price of the stocks connected to that technology. Most people do not separate those two ideas. They become excited about the future and assume the investment automatically makes sense. History shows that assumption can become very expensive. The reason I became concerned is simple. Every great bubble in history started with a truth. The railroad boom was built on the truth that railroads would transform transportation. The internet boom was built on the truth that the internet would change the world. The housing boom was built on the truth that real estate has value and people need homes. The problem was never the underlying idea. The problem was the price people were willing to pay because they believed the idea could only succeed. When everyone becomes convinced that an asset can only go up, valuation stops mattering. Investors stop asking difficult questions. They stop analyzing risk. They stop comparing prices to realistic outcomes. Instead, they focus entirely on the story. The story becomes stronger than the numbers. That is the environment where bubbles are born. And when I look at the AI market today, I see many of the same characteristics. I see extraordinary enthusiasm. I see enormous expectations. I see investors pricing in years of future success before those profits have fully arrived. That does not mean the technology fails. It means expectations can become too high. Think back to the dot-com era. Investors were absolutely correct that the internet would transform commerce, communication, entertainment, and business. They were right about almost everything. What they were wrong about was timing and valuation. Many companies were priced as if they would dominate the future forever. When reality failed to match those extreme expectations, stock prices collapsed. The internet eventually changed the world exactly as investors predicted, but many of those investors still lost enormous amounts of money because they paid too much. That lesson remains one of the most important lessons in investing. A great technology does not automatically create a great investment. Sometimes the better the story becomes, the more dangerous the investment becomes because expectations rise faster than reality. Investors stop asking whether future success is possible and start assuming it is guaranteed. I learned this lesson personally decades ago. Early in my career, I became extremely confident in a market forecast. I believed I understood exactly what would happen next. My conviction was strong. My analysis seemed logical. The evidence appeared overwhelming, and I was completely wrong. That mistake nearly destroyed my career. It forced me to rebuild from the ground up, but it also taught me something invaluable. The greatest financial risks often emerge when certainty becomes strongest. Whenever I find myself surrounded by confidence, I become more cautious. Whenever everyone agrees on the same outcome, I become curious about what might go wrong. Today, I see extraordinary certainty surrounding artificial intelligence. Investors assume adoption will accelerate. They assume profits will expand. They assume market leaders will maintain dominance. They assume future growth will justify current prices. Maybe all of those assumptions prove correct, but successful investing is not about asking whether something can happen. It is about asking whether current prices already assume it will happen. That question leads directly to valuation. Valuation may sound boring compared to discussions about revolutionary technology, but valuation ultimately determines investment returns. Imagine two companies with identical futures. One is purchased at a reasonable price. The other is purchased at an extreme price. Even if both businesses perform equally well, the investor who paid too much can earn disappointing returns. Price matters. In many AI-related companies, valuations have expanded dramatically. Investors are paying enormous premiums for future earnings that may take years to materialize. Those expectations create vulnerability. If growth slows slightly, if competition increases, if margins disappoint, or if adoption takes longer than expected, stock prices can react sharply. That is not because the technology failed. It is because expectations exceeded reality. While everyone was focused on AI, I began paying attention to something else. I started looking at assets that were being ignored. Historically, some of the best opportunities emerge where attention is lowest. Investors naturally chase what has recently performed well. They move toward excitement and away from boredom. Yet markets often reward patience rather than excitement. Over the last several years, I noticed increasing interest among central banks in assets designed to preserve purchasing power. I noticed governments diversifying reserves. I noticed growing concerns about debt levels, currency stability, and geopolitical uncertainty. These trends led me toward assets that behave differently from high-growth technology stocks. Instead of focusing entirely on future innovation, I became interested in protecting purchasing power and reducing dependence on a single economic outcome. Gold became one of those assets. The reason is not emotional. It is not based on tradition or nostalgia. Gold has a unique role in the global financial system. It cannot be printed. It cannot be created by political decisions. It has been recognized as a store of value across different civilizations and economic systems. When confidence in currencies weakens, gold often attracts attention. When uncertainty increases, gold frequently performs differently from traditional financial assets. I am not arguing that gold will outperform every year. I am saying it serves a purpose. It creates balance. It offers diversification. And in periods when investors become excessively optimistic about growth, diversification becomes increasingly valuable. The second area I focused on was international markets. For many years, American stocks significantly outperformed much of the rest of the world. As a result, investors concentrated more and more capital inside the United States. But investing is often about relative value. When one market becomes extremely expensive and another remains relatively inexpensive, future returns can become surprisingly different from recent returns. Some international markets trade at significantly lower valuations than their American counterparts. That does not guarantee success, but lower starting valuations generally improve long-term return potential. The combination of lower prices, economic growth, and diversification can create attractive opportunities for patient investors willing to look beyond popular narratives. The third category involves productive real assets. These are assets tied directly to the physical economy: farmland, natural resources, infrastructure, businesses that produce goods people need, regardless of market sentiment. The appeal of these assets is straightforward. They generate value through production rather than speculation. Food must still be grown. Energy must still be produced. Resources must still be extracted. Their usefulness does not depend on investor enthusiasm. In a world characterized by rising debt, monetary uncertainty, and geopolitical competition, productive assets can provide resilience that financial assets sometimes lack. None of this means I believe AI will disappear. Quite the opposite. I expect artificial intelligence to become one of the defining technologies of this century. The mistake many investors make is assuming that recognizing a powerful trend automatically tells them what price to pay. Those are different decisions. You can be incredibly optimistic about AI while simultaneously believing certain AI stocks are overpriced. You can believe a technology will change the world while still deciding not to own the companies associated with it at current valuations. Investing requires separating admiration for innovation from discipline about price. That separation becomes hardest when enthusiasm reaches its peak. So, why did I sell? I sold because investing is ultimately about probabilities, not certainty. I looked at valuations. I looked at expectations. I looked at investor sentiment. I looked at alternative opportunities. And I concluded that the risk-reward balance had changed. Could AI stocks continue rising? Absolutely. Markets can remain enthusiastic far longer than anyone expects. But investing is not about predicting the next 6 months. It is about positioning for the next decade. When I evaluated the next decade rather than the next quarter, I found more attractive opportunities elsewhere. I found assets with lower expectations, lower valuations, and greater diversification benefits. At the end of the day, every investor must answer a simple question. Why do I own what I own? Is it because I carefully analyze the numbers? Is it because the valuation makes sense? Is it because the risk-reward profile is attractive? Or is it because the asset has been going up and everyone around me believes it will continue? Those are very different reasons. One is based on analysis. The other is based on momentum and emotion. History repeatedly shows that when the two come into conflict, analysis eventually wins. Maybe not immediately, maybe not this year, but eventually reality matters. Cash flows matter. Valuations matter. Arithmetic matters. And when that day arrives, the investors who focused on numbers rather than excitement are usually the ones who preserve and grow their wealth over the long term.